Good evening, sir.
Good evening. Good evening.
Good Dhananjay, am I audible?
Yes, sir. Yes, very much, sir. Good evening, sir. Good evening, sir.
Good evening. How are you?
I'm fine, sir. Nice, sir.
Just tell me a few minutes about who are the participants now.
Yes, the participants are actually various faculty from different institutions all over India, sir.
Oh, fine.
We have from the Central University of Jharkhand and various MBA institutes in Hyderabad, and also from our nearby colleges in Nellore and Tirupati.
Oh, fine.
And some people from Vijayawada, we are Siddhartha Engineering College, sir.
Okay.
And we have got a good diversity of the faculty members, mainly from finance specialization.
Oh, good.
And from Bangalore also some financial markets faculty also joined, sir.
All right.
We have around 35 people that I think faculty members who are eagerly joined this FDP, sir.
Right.
Meanwhile, I will request Josna madam to Professor MC, sir, who is expert and who is in this financial markets and security analysis, portfolio management, managerial economics, and in fact, sir, I still keep that flavor of managerial economics, how he explains through graphs and diagrams. The flow I experienced in his classroom is still with me. I carry it when I teach in managerial economics for 8 years. I have tried to copy Professor MSR sir's philosophy and his way of teaching managerial economics, finance, and SAPM. That I still remember. Simplifying things, the way he simplifies. I request Josna madam to give a formal introduction.
Yes, sir. Sure, sir. Good evening to one and all who are all presented on this virtual platform today. And I welcome all the dignitaries who attended this FTP, that is day 4 session. And now I am going to introduce our today's resource person, Professor M. Srinivas Reddy, sir. Sir, Srinivas Reddy, sir, is an experienced professor with a demonstrated history of working in the higher education industry. And sir is served as director in Tirupati Smart City Corporation Limited and served as convener for APISET 2019. And sir is skilled in e-learning, finance, accreditation of educational institutions, coaching and strategic planning, strong education professional graduated from Andhra University and trained in IIM Ahmedabad, awarded PhD from SP University Tirupati, and sir have 11 national and 20 international publications. And coming to the specialization, sir is specialized in finance. And coming to the research interests of Dr. M. Srinivas Reddy, sir, sir is interested in finance and risk management, working as a chairman for Board of Studies of MBA and advising for 2 companies, that is spinning animal feed business. Occasionally, sir is working for Sri City Industrial Park Private Limited and served as convener APISET 2019 and 2020 and served as independent director of Tirupati Smart City Corporation Limited from January 2018 to June 2019. And sir is serving as a peer team member of NAC since 2009. Thank you, sir.
Yeah, thank you.
Sir, for the benefit of all the participants, I request all of you to follow Sir LinkedIn handle, which he uses very keen observations on Indian economy, happenings, markets, and I really cherish how he has made very incisive remarks on various things. And I'm happy to say that sir is a great well-wisher of our, he visited Narayana group, Narayana colleges. I requested sir, despite his busy schedule, sir is able to make time for us in various conferences, workshops, and various class. I requested sir to handle. Now, with great respect, I hand over this platform to Professor MSR sir for his discussion on this portfolio model and various things related to it. Thank you, sir. Thank you.
Yeah, thank you, Dhananjay. Am I audible?
Yes, sir.
Okay. Now, just to say a few words, we often talk in terms of portfolio. So we come across the word in different occasions. Number one, in general words, whenever we talk about to ministers, we hear the word portfolio. And in investment, this is quite often people are familiar with. Now, what is the meaning of a portfolio? I wish if anyone is responding, that's really good. Is it a mere combination of some securities as a portfolio or something more than that?
It's a combination of securities, sir.
If it is just combination of securities, any random combination, can it be called as a portfolio?
I request Rajesh Kumar sir to interact with sir.
Suppose I pick up randomly some stocks, so I call it a portfolio. Is it okay? Anybody can respond.
Dr. Rajesh Kumar sir.
It's a bundle of assets identified with set criteria. So what is that set criteria? Yeah, it's good that you are saying set criteria. What is that criteria?
That could depend on the assets which we consider for the portfolio, sir.
Example?
In case it is stocks, usually risk and return are the criteria.
Right.
Yes, sir.
Yeah, please.
Most assets, particularly if it is financial assets, return and risk will be the general criteria.
Okay.
In case it's not financial assets, it again.
No, we are talking in basically financial assets.
So return and risk usually are the criteria, sir.
So any combination should serve our purpose in terms of either increasing the return or reducing the
risk.
So that should be the criteria, right? So how do we do that work? So I wanted to combine. So with the same, either to increase the return or at least to reduce the risk. But how to know whether this combination is reducing the risk or not? What is the way out?
You want to have a negatively correlated assets in terms of.
Fine. So I am selecting. I'm trying to select at least some negatively correlated things, but in real life, there are very rare and few. So at best, we can get stocks with less correlation.
Low positive correlation.
Right? Low positive correlation. So that's also fine. But how to find out finally the portfolio risk? Suppose I want to minimize the portfolio risk. How to know that whether this combination is reducing the risk or not? What kind of calculation can be done? And how many should we add? Is it 5, 10, 20, 30, 50 or 100 or 150? How many should we have in the portfolio? So intuitively, if we think that diversification reduces risk, we may think that, okay, why not we have 50 or 70 or 100 or 150? Is it okay to have such a large number, or should we have less, or should we have more? Yeah, I'm waiting for some response.
The empirical research says around 30 were.
Dhananjay, let others take the opportunity of.
Okay, sir. For the interest of discussion, I intervene. Okay.
Yeah, that's okay. That's okay. I'm not stopping you. I'm just seeing whether others to respond or not. That's all. Because you said most of them are faculty members, right? If it is students, it's okay, but most of them are faculty members. I wish they respond. Otherwise, you can respond, no problem. I know about you well, so you know things. Yeah, please. Anybody, either you can say orally or type in the chat box as you wish. So which number is good in your opinion?
Dr. Rajesh, sir, please respond.
It's surprising that no one is responding. Some answer, don't worry about, see, as faculty members or as students, at least if you know the answer, fine, otherwise guess, or something close to that. Otherwise, it becomes monologue. Oh, I have some problem with the audio, Rajesh. The must be based on, yeah. Please type based on which number? Some number you please say. Others too can respond. It's not limited to Rajesh. Oh, cumulative wealth. I just wanted to know some number. How many stocks should I have in my portfolio to have the minimum risk? So I see some names here. Sri Likita, Saranya, Ravi, Muhammad Hamid Banu, Amida Banu, anybody? Maybe many other names are there. Can someone respond? Some number you say. Yeah, Syed Fayaz to everyone. Yeah, 20 is a good number. Can you say the reason for that? From answer 70, yeah. So someone said 20, Fayaz. What is the reason for that 20? We can analyze daily. That means you are saying that so if you have more number of stocks, it's difficult to find what is happening to the stocks. Okay, that's number one. That's number one. That's good reason. So if you have too many stocks in your portfolio, so tracking their performance, their news, etc., will become difficult. So therefore, ideally, you should have less. But what any reason for the 20? Why not 10 then? So 10 is more easy to track instead of 20. Yeah, Miss Syed Fayaz. Why not 10? Why 20? Please, waiting for the response. So I agree with 20, but tell me the reason why. If you say that tracking is the reason, 10 is more easy to track rather than 20.
Good evening, sir.
Yeah, good evening.
Sir, I'm Jansi from Vijayawada, sir.
Nice. Yes.
As far as I am concerned, I feel that there is no ideal number. It depends on the individual factors of an individual. Maybe the time he can spend, the investment he's having, the amount of investment, and the
Yeah.
updated knowledge on the stocks.
So you believe that it can be 10, 20 or 100? Anything is okay?
That means what I feel is it depends on the individual criteria. How
That's
far
what
we can.
Yeah, suppose
sir.
suppose we have more time exclusively doing the stock business, so even 100 is okay.
No, sir. Maybe maximum of 30 stocks.
So yeah. Any other response? That's fine. That's fine. You're giving some reason. Anybody else with any number? Actually, if you call risk, are there components in the risk, or there is only one name for that? How do we measure that risk? And are there components in that risk? Anybody? Suppose we said risk and return. Return, all of us, we know that. And risk, what is the name? Is there any statistical way of measuring that? How to measure that? What is the name for that? Are there components in that? Yeah, good, Rajesh Kumar, standard deviation. That's fine, we measure. But are there components, or is it single one? The risk beta is also there. Good. Suppose now we concentrate on standard deviation, for example. So are there parts in that risk, or is it single component? Do we divide that risk into any parts, or is it single one? Yeah, that's good. Systematic risk and unsystematic risk. So we also call that as market risk. For example, so when last time when COVID came out 2 years back, so all the stocks, the values came down, right? If you remember well. And recently, when the Ukraine war started and oil price went up, so all the stocks came down. So therefore, in the standard deviation, part of it is because of the total market. So because of something, if the entire market is affected, we call it as systematic risk because it's affecting all. And suppose there is a bad news to the company or good news to the company, so that stock alone is changing either upwards or downwards, right? So that's unique risk or unsystematic risk. So if for a portfolio, if we calculate the risk, that can be divided into two parts, as Rajesh is saying, systematic risk and unsystematic risk. Now, if you try to reduce that risk by adding one stock, another stock like that, if we keep on increasing it, in these two parts, market risk, we cannot do anything. Or systematic risk, we cannot do anything. For example, we cannot go and stop Ukraine war, or we cannot do anything related to the COVID or any other pandemic that is going to come. So market risk is common and we cannot do anything. So only thing is we can select companies. Somebody said with low positive correlation or if possible negative correlation. So one stock may go up, another stock may come down. Overall, the effect becomes zero, right? Whereas the market risk remains same. However big your portfolio is, mostly. So that means many people observed that when you are adding stocks one after another. Yeah. So from 15 to 20, you cannot reduce your further. That means your unsystematic risk will come close to zero when your stocks are around somewhere between 15 to 20. So that's the reason why most people suggest that have something 15 to 20, not more than that. So even if you add more number of stocks from there onwards, you don't get any benefit. Only result will be, as someone said, yeah, as someone said, it becomes difficult to track. Another reason is, normally if you select stocks based on return, we arrange them in a descending order. That means highest return on the top and lowest return on the bottom. So when you add more such stocks, what will happen? Your average return will come down. Is that right? Is that right or wrong? When you add more stocks, which are arranged from top to bottom, your average return will come down without any benefit. So have a portfolio with the 15 to 20. Any questions so far? Is anybody? Any questions so far? Oh, it's getting. Oh.
There is a question from the participant, sir.
Yeah, please. As somehow am I audible?
Yes, sir. Yes, sir.
Yeah, I lost the video. Let me see. Yeah, any questions so far?
A participant is asking about to explain some about returns, sir. How to calculate returns, sort of.
Yeah, we'll see that. So returns, there are two ways of calculating, especially for portfolio construction.
I'm afraid we have lost the connection. So meanwhile, when till SAR is again getting connection, I will explain this returns. So returns can be no, it can be decomposed into capital appreciation and dividend yield. So returns, how do we calculate it? Is dividend plus price gain. So D1 plus P1 minus P0 by P0 is the how we calculate return from an asset. So what is the cash flows it is yielding and what type of capital appreciation. So basically we want to know about risk and return of an asset to understand its total picture. Why I am saying total picture is, we assume a normal distribution of these returns, so that if we know mu and sigma, we have a complete picture of the distribution of the asset. So that is how we calculate the return part of the equation. So risk is calculated, as Sir has told, standard deviation of the returns. So return is simply what type of yield we are getting from the asset. There are two types of yield. One is a dividend yield and capital gains. Any more clarifications before Sir is no bit? I think the connection is volatile.
Sir, meeting is locked, sir. Some of the participants are asking, sir.
Yeah, it's not locked. I think I have released that.
Okay, sir. Thank you.
So the most important thing in this portfolio theory is the calculation of risk and return. And the fundamental thing in the finance theory is that if we know mu and sigma, we know about total distribution of that asset, assuming it is the returns follow a normal distribution. So all finance theory assumes that the returns follow a normal distribution. This is a fundamental thing. If we go for advanced derivatives, also Black-Scholes model, all financial models depend upon the normal distribution of returns. So that itself leads to a lot of controversy, where people say that returns don't follow normal distribution, and if returns follow normal distribution, extreme deviations are not possible. But we are seeing a daily, 10%, 15% moves in the stock returns. That's why they call it as a tails, or what Nassim Nicholas Taleb calls it, a black swans. Black swans are events which are outside the normal distribution, which are in the tails. That's how the finance theory goes. So latest theories which are coming into picture is extreme value theory and all these things, where they say that returns of the assets are no longer following the normal distribution. Any other questions? Still things are connects again. I can ask other participants also to share their ideas on this security analysis portfolio management, for the interest of time. Rajesh sir, are you there? In fact, Rajesh sir is a famous faculty of finance in Bangalore and various parts. Okay, Rajesh sir is having some issues with the mic. Any other participants who would like to share their observations on this portfolio theory or security analysis portfolio management? Satish Kumar sir? Let me take out some my PPTs so that meanwhile sir login.
Hello, sir. Good evening, sir. Am I audible, sir?
Yes, yes, sir. Very much, very much, very much.
Yes, sir.
Rajesh, sir, I request you to please share your thoughts on this SAPM and some of these things.
Yes,
Because
sir.
we lost suddenly the connection.
I understand, sir. So, good evening, participants. In fact, it will be interesting to know the background behind this portfolio theories. And time permits, I request all participants to read one book, Against the Gods. I'm putting it in the chat. It's by Peter Bernstein. And this book actually tracks, it's all about risk management from the older times till date. It's how risk evolved and how it is managed. And very beautiful stories, very beautiful aspects have been given. And one of the story in this is how this Markowitz theory evolved. It's awesome, what to say, background. We know now it is Markowitz theory. In fact, we call modern portfolio theory, but that's one of, actually, this is the first theory that evolved in portfolio management, portfolio construction. I'm sure many of you are aware, Harry Markowitz was he was a student of mathematics, and he was pursuing his research in University of Chicago. What I'm quoting is story from this book, Against the Gods. He was pursuing his research in University of Chicago. And one day when he was waiting to meet his supervisor, the dean of mathematics department, there was another person waiting for the same professor, and he was a stockbroker. And when they were discussing, the stockbroker asked Markowitz, what is this?
I just lost the connection
Yes,
so
sir,
far.
yes, sir, yes, sir.
Somehow I'm calling from the phone now.
Oh, okay, sir. Okay, sir. Okay.
Yeah.
Yeah. It's, please, sir. Please continue, sir. I just asked some our participant, Professor Rajesh Kumar, sir, to just say a few words. Please continue, Professor.
Actually, I just wanted to send a file also. I made some calculations here. I don't know how to do it now because, yeah. Is the question was related to the calculation of returns, right?
Yes, sir. Yes, sir.
So returns you take from the appreciation or depreciation plus whatever dividends, etc., adjusting for bonus, splits, etc. So this is what we are supposed to do while calculating the returns. And these standard deviations can be calculated based on the observations, monthly closing prices or weekly closing prices, and convert that into yearly standard deviation. So this is what we do for calculation of risk and return. Yeah, anything, any other thing? Any other question?
Sir, is there any relationship between Markowitz and Sharp and his Nobel Prize? Any anecdotes, sir?
Yeah, actually, they got Nobel Prize for that Markowitz portfolio selection only. In fact, I made some calculations to show you.
Okay.
How are you calculating Markowitz combination? For example, we calculate standard deviation of two stocks, right? And then correlation or covariance between those two stocks. And then we calculate when we combine them into different weightages, right?
Professor, can we have your video, sir? Video is not done.
Video, yeah, I'll try to. File I'm trying to share. Yeah. But how to share that file I'm trying to do.
Chat box, I think we can put in chat box. Eh?
No, file is big file. I made calculations for this class today. Unfortunately, it is not working. Now, okay, how do you calculate standard deviation of portfolio? Using that Markowitz formula for you find out covariance, standard deviation of A and B, right? Using the formula for combined standard deviation. So if it is reducing, we like it. If it's not coming down, we do not like it, right? Now the problem is, if you have 2 stocks, fine. If there are 10 stocks, how many standard deviations should we calculate? And how many covariances should we calculate? Anybody? Any response? Maybe Rajesh will respond.
10 C2, sir. 45 correlations.
So
45 covariances.
Yes, sir. So basically, then is it possible to find out with that many combinations? So what is the best combination of with the 10 stocks? With the 2 stocks, fine. But if I'm having 10 stocks, is it possible to have an ideal combination with different weights?
Very difficult, sir.
Is there
Almost
a way out?
impossible.
Is there a way out? Anybody? Now,
That's sorry.
Now, suppose go back to the 2 stock example. So in the textbook, normally we have that formula, right? For 2 stocks with different weights. I think most of you might have seen. Chusara, the example, 2 stocks ki portfolio with Markowitz selection. Yes or no?
Yes, sir. Yes, sir.
Now, actually, you can try a different way with Excel. That is, standard deviation calculate past data కావాలి కదా? Anybody? Maybe Rajesh. Past data కావాలనా అక్కర్లేదా standard deviation కి?
We need, sir. We need historical data, past data.
Historical data. Based on that, we are calculated standard deviation and written, and then we are finding out the portfolio combination. Now, instead of calculating standard deviation individually for all the stocks, for example, again those 2 stocks, you can calculate. Suppose I am combining in the ratio of say 50-50. Stock A and stock B as 50-50, right? Past data alone, you take 50% and combine them into one distribution. For that, you calculate standard deviation. Have anyone tried this? Yeah, I'm asking you, have anyone tried this?
Yes, sir.
Try చేశారు ఎట్లా పాస్ట్ డేటాని వెయిట్స్ అంటే స్టాండర్డ్ డీవియేషన్ 50-50 కాదు డిస్ట్రిబ్యూషన్ లోనే 50-50.
Distributions 50. Returns itself 50.
Every month returns itself 50-50 తీసుకుని turn this as a single distribution.
Correct.
Right? For that, you calculate standard deviation. You get the same standard deviation which you get with the Markowitz formula.
Yes.
అర్థమైందా? Right? If possible, I'll send the file, but now I'm unable to do it. Okay. Then the next question is, can we extend this to 10 stocks? So I took the data for 10 stocks, right? And the data for last 12 months, right? And I just try to apply the weightage to all the 10. So for example, random got 10 weightage తీసుకున్నాం అనుకోండి. Okay. We do not know whether it is the right combination or not. 2 stocks either we can try different combinations and see the standard deviation, and you can find out where you are getting the lowest one, and therefore you can select it. But when you try more number of stocks, we do not know where exactly which combination is going to be the. Someone is saying. Hello. Am I audible? Hello.
Yes, sir.
Yes,
Yes, sir.
sir, you're audible.
So you take 10 stocks data, take the past distribution for all the 10 stocks, and use solver. Excel లో solver అని ఉంది. Good idea ఉందా మీకు?
Yes, sir.
There is a feature called solver. So weights మీరు random గా ఏదో ఒకటి ఇచ్చేయండి, పర్వాలేదు. Don't worry about any weight. You can give 0.1, 0.2 or something like that, whatever weight. And you sum up those weights. So 10 stocks కి ఇచ్చిన weights ని sum up చేస్తే కనుక మీరు random గా ఇస్తారు కాబట్టి అది less than 1 ఉండొచ్చు, more than 1 ఉండొచ్చు, right? Okay, then in the solver you put following conditions. Number 1, so the sum of these weights must be equal to 1.
1.
Right? That's number 1 condition. Number 2, it may give negative values. అంటే ఏంటి, షార్ట్ సేల్ వాల్యూ కూడా ఇవ్వచ్చు అది సాల్వర్. Short, and that means to maximize the return or to reduce the risk, it may say that sell some this stock. So to avoid that, so 1 to 10 stocks low, you put a condition that each of them, the weight of each of them should be 0 or more than 0, right? Equal to or greater than 0, positive 1. Okay, so that's a second condition. Okay, then in the solver you have functions like minimize or maximize. When మీరు క్యాలిక్యులేట్ చేసినప్పుడు random గా ఏదో వాల్యూస్ ఇచ్చామో, సింగిల్ డిస్ట్రిబ్యూషన్ కింద we convert with those values, we get one single distribution. For that we calculate standard deviation. Some standard deviation ఏదో వచ్చి ఉంటుంది, suppose 8 or 20 or 30 ఏదో వచ్చి ఉంటుంది. Then in the solver function you say that minimize that value. Okay, then you ask for solution. So obviously immediately you get a solution that this is what minimum standard deviation, and it will suggest the weights for stocks 1 to 10. If you like that, you keep it. And the beauty of this particular method is you can suggest, suppose a solution lo 4 stock lo 5 stock lo 6 stock lo vachuntai, for example. You don't like that number, you want a minimum of, say for example 4 or minimum of 6. You can put one more condition that number of stocks must be equal to so and so, 5 or more. If you want minimum 5 or more. So you get a combination of portfolio with this method, minimizing your risk with this many minimum number of stocks.
Sir, what's the function for the last condition you mentioned, sir? Number of stocks should be greater than equal to 5. How to put that condition on solver, sir?
You just count the stocks 1, 2, 3, 4, 6, 7.
Oh, okay, so we should have given stock numbers.
You can give stock numbers.
Okay, okay, sir. Okay.
Count. Suppose in the weights range, you can use the function count.
Count. Okay. Okay.
Count if it if it is equal to or greater than, if it is greater than 0.
Okay.
Then you get number, right? The weight zone in that range. So you get number of stocks.
Okay. Oh, okay, so, sir. Okay. Okay. Okay.
This you can get easily with the solver if you have the historical data for these stocks. Any questions so far? And if I want one more condition, for example, I want a minimum dividend of 2%, for example. So you multiply these weights with the dividends, right? And then you say, so put one more condition, my dividend should be more than or equal to 2%. Again, you solve it. Or you put another condition that my minimum return should be at least 10%. Again, you solve for it. So you can have these parameters, you can go on changing as you like, and find out your portfolio if you have the historical data of your stock returns. And your return is equal to multiplication of weight into the return, concerned stock return. Isn't it? That's a simple formula, right? The weight of your stock and the concerned return of that particular stock multiplied plus a number of stocks we have in the same way. So that is the expected return of your stocks. So this way, we can easily do the Markowitz portfolio selection with the Excel. You can extend this to any additional number of stocks, maybe 50, 100, whatever you have. Any questions so far? Yeah, anybody, any question?
Sir, in case it's okay with you,
Yeah.
if I'm permitted to share the screen, I will open an Excel sheet. Can just guide, sir? I will just do the process. Can you guide on how to do it, sir?
It takes time. It took a lot of time for me to do that.
Okay.
I'll share the file. It's not an issue.
Okay.
Maybe tomorrow with Dhananjay, I'll send the file.
Okay, sir.
Sure, sir. Sure.
Yeah. Any other question?
I have small question or this thing, sir.
Please.
How we are transitioning from Markowitz to single index model, sir?
No, actually, if you think the historical calculations what we made are reasonable, and if they are going to happen in the next year also, there is no need to move to the single index model. The issue comes only you calculated the historical standard deviation and return, but there is no guarantee the same thing would continue in the next year. Then how do we go about this selection? This selection will not be satisfactory. So portfolio manager may have subject to forecast for next year, right? Then people cannot use this model easily. Therefore, they go to single index model. If they are close to what were observed last year, there is no need to move to the single index model. But normally it may not happen, right? The same standard deviation, same return may not be occurring again for next year. So therefore, they move to the single index model.
Is it possible that calculations are coming down, number of calculations required?
Yeah, calculations will come down compared to the single index, the Markowitz based model, because here we use n into n minus 1 plus return for each stock, right? That many combinations we require in Markowitz. Whereas in single index model, we require beta, right? And risk for each stock. So those two are unwritten for each stock. So these are sufficient in addition to the market return and market standard, market risk. So therefore, number of calculations will come down drastically in single index model.
Can you throw some light on beta, sir? We want to hear more about it.
So beta, I think almost all of you are aware. So it is a we use the simple regression model is y is equal to a plus bx plus e. So this is what we are using. People calculate that in two ways. Number one, you calculate return. Say, for example, if I am calculating for monthly closing prices, we find out return, convert that into percentage. So those observations for market, say, for example, Nifty and for a stock. So we use the regression model, right? All of you are aware of the regression model. That B value is equal to beta. That means the variance occurring in the stock return based on variance occurring in the market return, right? And E is the error factor. So this is what some people use, but some people use absolute values instead of percentages. But in most of the textbooks what we read based on the percentage returns. Again, the problem is will the beta calculated based on the past data, will it remain constant for the future? There
No.
is doubt. There is doubt. So it needs to be adjusted. Here maybe you came across the word mean reversion. Mean reversion. You might have heard this word. So that means most of the numbers tend towards the mean. Mean is something like 1. So if the beta is, say, for example, you got 1.5. So they make an adjustment like, so 1.5 into 2 by 3 plus 1 into 1 by 3. Right? So the value will come down compared to the 1.5. So this is one way of adjusting the beta, adjusted beta. Or you calculate for the past 5 years beta, right? And then you see how the beta is changing in the last 5 years or 6 years. You find that beta is moving in a direction with a change at a particular rate. So that means that is the rate of change that is occurring in the beta. With that change, you adjust the beta. These are the two ways of adjusting the beta instead of using simply the past beta. Is that clear or any question?
Yes, sir. In the interest of discussion, I need your comment, sir.
Yeah.
Do you feel that companies' profits and companies' growth also mean reverting?
So there's a lot of discussion on should we use single factor beta or multi-factor beta. So here we are using single factor beta that is based on the market. So some people that tried with industry size, EBAT, interest rates, like important factors that affect the market. Now what will happen there? It becomes something like a simultaneous equation or more number of equations within instead of one equation. And in each of that you have an error factor, right? So you might have heard the word y. So R square. So to what extent the variance is explained? If the R square is very high, that's good. If the R square is less, that means there is a variance, but it's not explained by the independent variable. So therefore, if you use more variables like EBAT, interest rate, foreign exchange rate, industry size, many other factors, right? Price of that particular product, etc. As many variables as possible, you can use. Many people tried that, but the test of that is if there are multiple errors, small multiple errors, the sum of those multiple errors must be less than the error that occurred in the simple equation of y is equal to a plus bx. So that means market-based beta. If that is satisfied, you can go for multi-factor beta. But many people observed that the combined error is not significantly less when compared to the single factor beta. So therefore, people are still using that, right? But if there is an industry or any company for which multi-factor beta is sufficiently good, that too with adjustment, okay, that can be used.
Yes, sir. Yes, please.
Yeah, anybody else? So now there is a saying. So when you are diversifying, going back to the previous example of having 10, 20 or 15, some people what they do is they try to have less number of stocks in the portfolio, say for example just 10. The reason is if you spread across many, if there are good stocks which are returning higher percentage of return, so the weightage will come down, therefore your overall average return will come down. So some people what they're doing is they concentrate their investment in 10 or something around that. It's not a perfect number. And they add index into the portfolio. as one of the stocks, like exchange ETF, exchange traded fund or fund of fund. So therefore, that will ensure diversification into the portfolio. At the same time, you can concentrate on the stocks which you like most, which you expect will give more returns. So that means the saying of don't put all your eggs in one basket. That's the principle of diversification. And some people say, no, you put them in one basket and keenly watch them or carefully watch them. So depending upon your preference, you can do either of that. So, but just for diversification, add Nifty or whatever index you think is good enough. So that ETF or fund of fund, which is tracking that particular index, you add in your portfolio. Is it okay? Any questions? Or any points? Need not be only questions. Any points you want to say?
So how do we understand this Warren Buffett's theory? Sir, that is diversification is not that is some sort of proxy for ignorance sort of thing. He makes some statements.
No, he says that his fundamental statement he gives is invest in the business which you understand.
Yes, sir.
Very well. Understand very well. The business, if you understand very well, you invest. Otherwise, if we simply go for diversification without understanding the business, that means we are only investing based on our ignorance. So he says that some business I don't understand. Even if others are recommending, so I don't invest in those companies. That's what he says. So for example, he says he missed many technology companies because he didn't understand their business. In fact, real life also, I see some of my friends, so they have some particular knowledge, say for example, chemistry people, they know chemistry very well. Therefore, they invested in companies which make chemicals, or some engineering faculty here. So they invested long back in companies like L&T. So they got good money. They know what their business is. So that's a good example of Warren Buffett. So if you understand the business well, so you can really know what is happening, when to invest, when to get out of that. Otherwise, I'll just give one example. So last, I think 1.5 years back, there was a company called HEZ. So the share price started moving from 50 rupees onwards. So it started moving, and it became 300, then 600, and it started still moving up. It became 1,500, 2,000, 3,000. What do you think was the reason for that? If anyone is aware of that company. So it became 3,300. So all in, I think less than 6 months or 8 months. So if we are not aware of the business, suppose you have that stock. Suppose we do not know what is happening to the company. Why is that share price moving up? Right? Maybe we will sell somewhere around 1,000 or 500 instead of waiting for the 3,000 rupees. So that's what Warren Buffett says. So this is known as, if you want to know the reason, they make electrodes. So electrode prices went up significantly higher in that period. So their profits became 4 or 5 times. Right? Okay. Now it is trading at 1,300 rupees. Should we buy it now just because it came down? The same company is now trading at 1,300 from 3,300. Should we buy it or not?
It depends on the future prospect for electrodes, sir.
Yes, that's what I'm saying. So Warren Buffett says that if you understand their business well, you can really make good investment decision. So if you know what is the price of that electrode, what is the demand for that, what is the raw material price, and what is the industry, what is China doing it, right? What is the trend of steel making? Will it go to electric or will it still continue in the blast furnace route? So like that, if you understand the business well, you can really make good decision.
Sorry for interrupting, sir.
Yeah.
I am in this context. I'm tempted to this buy this Paytm, sir.
Yes.
Many people say that newspaper says 70% has fallen down.
Yes.
So that is the dilemma, same dilemma that you are commenting on or explaining.
So actually, now one way is if you really understand the revenue model, fine. If you don't revenue, there are 2-3 ways of selecting a company. Number one, as if you know the business well, if you know the revenue model, and if you can make really some projections of their profit, that's the best thing. Otherwise, you find out a similar business elsewhere, here in the country or in some other country, right? So valuation models, if you look into some of the valuation models, one is discounted cash flow model or price earnings model or sales into some sales multiple one, right? Unfortunately, this Paytm, etc., when they were issued in the public issue, IPO, some multiple into the revenue is something very high. So 17 times of sales, not earnings, right? So that I believe was very high. So compared to other countries, yeah, in other countries they never got that much value. So they say that in future we make a lot of money, maybe, but we do not know that. That question mark is always there. Now then, so if it came down, so what is the base price? 70%, 30%, or 40%? What is the right price for that? So just because it's coming down, we do not know whether it is right or wrong. So there is again a theory, greater fool theory. So that means I don't understand this share price, but I think it will go up because others will buy at higher price. So admitting that I am a fool, I expect there are many other fools who can buy at a higher price.
Yes, sir. Sometimes I just wanted to share my doubts, sir. Doubt
Yeah,
or fear.
Yeah.
Sometimes I fear that these falling companies,
Yes.
when the stock price of a company falls, it brings its own momentum.
Yes. Yes.
So that it's some sort of a reflexivity builds that the companies will shrink itself.
Yes. Yes.
As we see, if the stock price goes up, there is a positive momentum and the company itself becomes bigger.
Yeah, there is a possibility. Yeah. It's like something
Sometimes
like
I am afraid. It may implode, sort of thing. Is some sort of reflexivity.
Yeah. Yes, that's their so-called feel-good factor. And moreover, most of the employees, they are get paid in terms of ESOPs, right?
Excellent, sir.
Employee stock options. So when the stock price falls, so most of them may get demotivated. Yeah, some of them may get less interested. That may happen. Whereas some people take that as a challenge and work well if it is only temporary. But if it is a permanent feature because of something happening to that company, so nobody can help it, right? Either positive or negative. The trend would continue if it is because of fundamental change. Yes, please.
Yes, sir. Please continue.
No, it's okay. I'm just waiting for any other responses.
And one more, I request your comment on active versus passive investing, sir. Some people say that portfolio managers can't deliver more than index returns.
No, based on so, in fact, we don't have good information on managers per se. Usually, this Morningstar and other ranking institutions, they give rankings for funds, right? But mostly they do not give information on who is managing and who is their performance. So therefore, in the developed market, people say that over a long period of time, so we don't get much higher return. But I personally believe that there is some addition because of the managers. There is, but that additional benefit may be taken away in terms of their fees, their expenses, etc. Definitely, they're adding more than what index is giving in many funds. So, if someone wants really some extra return, they may select good funds. Some are really giving good return compared to the index also. And another thing is, what kind of fund is that? Is it really reflective of the index, or are they investing in some sectors which are not represented in the index? So if they're investing in such stocks, maybe they can give more return. But if they're reflecting just the index, better to go for ETF. Yeah, anybody else? They can share their points also. Just they don't have to listen. If they have any points to share, please share.
Sir, which stocks are better for long-term investment in the application?
Madam, that you have to select. There is no perfect answer for that. You have to select.
Okay, sir. Thank you.
Because, so just because we think it may not really happen the way we think because of changing situations. Any other comments or any other points you want to add?
Good evening, sir. I'm Dr.
Yeah.
Sirisha from
Please.
Hyderabad, Bangalore.
Yeah.
I did my PhD from Hyderabad Central University, MBA from Andhra University. Good, sir. It's our privilege to hear your lectures, sir. In fact, can you just share some of the topics where we can do further research?
It really depends on your interest, madam. Number one, for example, if you have access to data, you heard something like sector rotation.
Oh, yes, sir.
You heard of that word, sector
Yes,
rotation?
Yes, sir. Yes, sir.
So that means, for example, you wanted to publish a paper or do research. So you take FIIs and DAIs.
Yes, sir.
So who is doing this sector rotation better?
Oh, interesting. Yes,
Isn't it? That's quite interesting, isn't it?
Yes, sir. Yes, sir. Really.
The result may be anything. Result may be, say, one may be doing better than or they're equally good or equally bad. That itself is a good finding, right?
Correct. Yes, sir. Agree.
So, like that, you can think of many things in this area.
Okay, sir.
Only thing is, two things you should have data. Number one, you should really have some ability to crunch those numbers.
Oh, correct. Yes, sir.
Right? Or for example, you heard the stocks with the differential voting rights, isn't it?
Correct. Yes, sir. Yes, sir.
No, any name can you tell where differential voting rights in India?
అందుకే తెలియదు sir. I heard that.
For example, Tata Motors.
Yes,
So
sir.
they have two types of shares. One is with voting, and the other one is without voting. So the stock price, they vary in different prices they trade.
Okay.
So what is the reason for that? Is that difference worth it or not?
చాలా బాగుంది, మంచి ఐడియా సార్. కరెక్ట్.
You can think of many things.
బట్ దీనికి డేటా మనకి ఎక్కడ దొరుకుతుంది సార్? ఇది మనం డేటా అవైలబిలిటీ, ఈ డిఫరెన్షియల్ రైట్స్ కి డేటా
రేట్స్ అయితే డైరెక్ట్ గా ఎక్స్చేంజ్ లోనే ఉంటాయి. రేట్స్ అయితే రీజన్స్ ఇఫ్ యూ వాంట్ టు ప్రూవ్ యూ హావ్ టు డు ఆన్ యువర్ ఓన్. ఆర్ ఇఫ్ యూ వాంట్, డు యు వాచ్ స్టాక్ ఇండెక్స్ వాచ్ చేస్తుంటారా?
అంతగా అంటే నాది రీసెర్చ్ అంతా బ్యాంకింగ్ సార్. జస్ట్ డెవలప్డ్ ఇంట్రెస్ట్ ఇన్ ది ఈక్విటీ మార్కెట్.
ఓకే.
నాది
ఫర్ ఎగ్జాంపుల్, every morning we get index opening in Singapore, right?
Singapore, yes sir. First
Singapore వస్తుంది. Is it really the leading indicator always or not? No, you can verify that. The result may be positive or not, right?
Correct.
So you can think of many things in this field. Or some people think that based on Dow Jones it's opening, not
Singapore. Oh no.
So what is happening in the Dow Jones futures, it is happening. So you can verify if you are good in that statistical analysis.
Equity market, correct. Bonus, sir. I'll be in touch with you, sir. Definitely.
No
Thank you. Thank you so much, sir.
Thank you.
Hello, sir. You are
Yes.
from this place, sir. I'm from Hyderabad. So if I want to invite you for our college, can I contact you, sir?
Madam, I am from Tirupati.
Okay. I am the product of Tirupati only, sir.
Very good.
40 years back.
Well, nice to hear you.
Right now, I'm in Hyderabad working as a head of MBA department in Sridevi Women's Engineering College. So, want to have, of course, webinars you can give, I think.
If possible.
If possible. Okay. Thank you, sir. Thank you.
Thank you very much.
అదే నేను కూడా అడుగుదాం అనుకుంటున్నాను సార్. ఇఫ్ పాసిబుల్ ఆన్లైన్ వెబినార్స్ విల్ యూ ఏబుల్ టు బి రైట్ సార్? ఆన్లైన్ ఎఫ్డిపిస్ కానీ ఇలాగా చేస్తారు కదా?
Maybe one session I can take, not many.
Okay.
Andhra University campus amma meer chadindi?
Yes sir, Andhra University campus.
Very good. I am also from the same campus.
ఏవి రంగనాథాచారి గారు తెలుసా సార్? ఎకనామిక్స్ అండ్ బ్యాంకింగ్ అండ్ రాశారు పుస్తకాలు.
లేదు, తెలియదు నాకు.
డిఎన్ఆర్ కాలేజ్ ఆంధ్ర యూనివర్సిటీ ఆనరీ ప్రొఫెసర్ కింద కూడా చేశారు.
తెలీదమ్మా. నేను I studied long back, very long back.
Okay. మా తాతగారు, మా మదర్ వాళ్ళ అంకుల్.
So nice. I did there in 81, 83. That's very long back.
అప్పుడు పుట్టలేదు.
That's what
during the same period, I did MPhil from Tirupati SV University under Kamaraj Pantul garu.
Oh, so nice, madam. So nice.
Kamaraj Pantul garu. So I am the native of Nellore. I was the native of Nellore. So I was so fascinated to attend this webinar because it is from Nellore Narayana Institute. I was the product of VR College Nellore. So nice, with that, yes sir, thank you very much. So nice of you for giving, for responding our things.
Thank you. Yeah, Dhananjay?
Sir.
Anything else? I'm sorry I could not share that file today because of my net connection and all.
No problem. No issues, sir. No issues.
Sir, good evening, sir. Sudhir, sir.
Good evening, Sudhir. How are you?
Sir, I am good, sir.
Good,
Nice
good.
to see you after a long gap, sir.
That's
I'm
nice.
feel very happy, sir, interacting with our students.
Oh, nice. So nice.
Thank you, sir. Thank you so much, sir.
Right, thank you.
మీకు రాజశేఖర్ సార్ తెలిసే ఉంటుంది, బెల్లంకొండ రాజశేఖర్ సార్. హైదరాబాద్ యూనివర్సిటీకి, సెంట్రల్ యూనివర్సిటీకి దీని కింద
తెలుసమ్మా.
ఆ యూనివర్సిటీలో పిహెచ్డి చేస్తాను సార్, హైదరాబాద్ సెంట్రల్ యూనివర్సిటీ.
ఓ సో నైస్ అమ్మ. తెలుసు నాకు రాజశేఖర్ తెలుసు. అక్కడ ఈ మధ్యన లోక్నాథ్ అని ఒక
లోక్నాథన్ సార్, ఫైనాన్స్ ఏరియా. డెఫినెట్లీ మిమ్మల్ని పిలుస్తాం. థ్యాంక్ యూ సార్ ధనంజయ్ సార్ ఫర్ మీ అందరూ ఉన్నారని జస్ట్ ఎన్రోల్డ్ ఇమీడియట్ గా. మా సార్ మీరు అందరూ చూద్దామని ఒకసారి విందాం. ఎవ్రీ డే ఇట్స్ లెర్నింగ్ ఫర్ అస్. థ్యాంక్ యూ సో మచ్. థ్యాంక్ యూ సో మచ్.
Sir, any concluding remarks, sir, from your side?
So one thing is, carefully, whenever you wanted to invest in any stocks, first study about the company, read the entire balance sheet. Read the entire balance sheet, including notes. And if they have subsidiaries, try to understand what is their value. So that's next. If you can, you identify the key success factors for that stock. For any stock, you can identify about 3 key success factors. So those key success factors you watch if you are investing. So these are the concluding things I can say about.
Thank you, sir. Thank you very much for enlightening us and interacting with our. It's always a pleasure to have you, sir. Now I request some of the participants to give their observations, feedback, or any suggestions or observations. 1 or 2 participants. I request Rajesh sir. Is Rajesh sir there? Or Srinivas Rao sir from Acharya Nagarjuna University?
Sir, Dhananjay sir, namaskar sir. Myself, hi everyone. Myself Srinivas Rao from TJPS College, Guntur. I'm very happy to be part of this faculty development program being organized by Narayana Engineering College. And especially, I'm very much grateful to for today's session, sir. Professor Srinivas Reddy sir. Actually, I met him personally also doing my PhD work. So it's very interactive and participative, and in a simple manner, sir has explained the Markowitz portfolio selection theories and simplex model, single index model, etc. And thank you very much, sir, for taking initiative in organizing these type of faculty development programs nowadays. Thank you, Srinivas Reddy sir and Dhananjay sir, for giving me this opportunity. Thank you, Vanan.
Thank you, sir. Any other faculty members want to give their observations? In fact, really, I always I feel a student in Professor MSR classroom. Whenever he addresses us, that much enthusiasm, and it takes a genius to simplify a concept.
Yes, so, sir. Yes, sir. Exactly, sir. Exactly.
So that type of flow and the simplicity with his vast knowledge and wisdom, and the way he participates in the markets. Only a person who participates in the markets can simplify those things.
Yes, sir.
I request any other observations from the.
Sir, good evening, Dhananjay sir.
Yes, please.
Yes, sir. I'm Dr. Mahbub Basha, sir, head of the department MBA, sir, Narayana Engineering College. Yes, sir. Dhananjay sir only can conduct these kind of programs by taking the risk involved in this. So, first of all, I would like to congratulate the Dhananjay sir, sir.
Yeah, Basha sir.
Yes, sir.
there is no risk, as Professor Remesar sir told, because I understand the field well.
The risk in the sense, in my context,
Yes.
risk means.
No, I'm just joking. I'm just joking.
No, in the sense, by organizing this kind of such a great programs, it involves a lot of risk also. And very few programs like this are organized by the institutions, and you stand one among them by organizing these kind of programs, sir. That is what my intention.
Thank you, Bhash. No, as sir has told, there is no risk if you know the business.
Yes, sir.
So that's why I commented like that. Now, thank you very much, Bhasha sir. Now I request Josna madam to give vote of thanks. Is a formality for our Professor MSR sir. Josna
Sure,
madam.
sir. Sure, sir. Now I would like to thank Professor M. Srinivas Reddy sir to provide to share his valuable insights and to provide valuable information regarding this portfolio management, sir. Exactly what is meant by a portfolio and how do we calculate risk and what is a return, and for clarifying so many doubts from the participants, and for giving valuable suggestions regarding this, how to invest the stock, and at the time of investing the stock of a particular company, what we have to get the information, and this sector rotation, different concepts. Thank you, sir. Thank you for spending your valuable time for us. On behalf of all the participants also, once again, thank you so much, sir. Thank you all.
Thank you. Thank you, everybody.
Thank you, sir. Actually, we are very blessed to have you, sir, because you have never refused our request, either in the conferences, webinars, or workshops. Thank you so much, sir.
Thank you.
Take leave of you.
Thank you. Good night, everybody.